So it doesn't matter what time frame we analyze, it doesn't matter what chart we're looking at, the craziness continues. The reality of this being the reality is very, very strong. The ability to recognize that the world of trading from the market maker's point of view is a world of statistics and probabilities. The Federal Reserve told us almost as such, because the Federal Reserve came out and says we are very aware of the arrival of rates, the arrival of orders when we play the market maker's game. The one thing that you're very conscious of is grouping of your stops, your sell orders, sorry, or the grouping of your buy orders. So in other words, if your buy orders are all too close to each other, you're getting very, very concerned about a market move against you. So the only time that those buy orders would be grouped close together is when you're not concerned. Otherwise, the market maker's made a blunder. That's what the transform process extrapolates out of the charts. It finds those areas where there is a skew, and it tells you stop being so clustered in your sell orders or your buy orders, and therefore get more aggressive in your sell orders or your buy orders. From that, things start to ping off your page. You see where the trade should be. You see what happened next. You see where the market's skewing on the wrong side of the move. And when you see where it's skewing on the wrong side of the move, you can decide to trade on the right side of the move. If you look at the bonds on a 15-minute chart, when did the skew come in? Well, the skew started to run the skews all the way through this process. Look, as soon as you saw an unfair high here, rising all the way to an unfair high here, you're already bullish, aren't you? You're already massively bullish. So you go to the lows, you go to the unfair lows, you go to the lows of these areas, and you start getting ready to find buying opportunities. It's that easy. So you say, right, I've got to run through the skews. The unfair highs are pulling. I'm going to be aggressively buying. The unfair highs are pulling. I'm going to be aggressively buying. And you end up with a simple trade that then rips for an absolute fortune today. Rips for a fortune. Remember I told you about the stop orders at 0.8s, where the price would be a sell? Well, we got very close to that 0.8, didn't we? Somebody traded it up to 0.7s, which is pretty good. So you can see the story that we were taking advantage of. Overlay that with an order flow story, and you wonder why Reeve tries desperately to get you excited about the spectrometer. Because the shakeout is the spectrometer. It's not a different indicator, guys. It is the spectrometer, right? It's just the pin zone from the spectrometer, but it's generated by the transform process. It's not just a shaded area. It's a probability distribution area. So when we know what the probability distribution's doing, we can start reading the story. So for example, when we came into the low price here, you can see that this sell trade was a given, wasn't it? When you think about it, look, can we all agree that this sell trade was almost definitely a given? The unfair low was here, the new unfair low was there, correct? From that unfair low to there, from there to there, we would then take the unfair high and say, well, where did the unfair high go to? You say, well, anything above that line is probably going to be a sell trade, right? Anything above that line is probably going to be a sell trade. So you then take a sell trade and you say, okay, I'm in it. And then what happened? The skew accelerated. The skew accelerated aggressively through that phase, didn't it? But what happened at the very bottom edge? What happened here? The next one flattened. We got a flat line neutral. We got a flat line neutral skew, didn't we? So now you're reading it from the point of view of saying, okay, well, it's flat line now, so where am I going to get a sell? Where am I going to start working this neutral zone to? And we normally expect that to be fair value. And because of that, you're kind of starting to look maybe at this price here and saying, well, I think maybe it's going to run this as maybe a normal neutral distribution here now. And you start getting ready for the possibility that that might actually be the case. And obviously you start thinking about that as a possible change in the storyline, don't you? And then this is exactly what happened, because then we started to see this unfair high developing at higher prints, this unfair high from there to there, and as we just drew in for you earlier, this buy trade comes in at higher prices, and then we get this humongous break north, and so on and so on and so on. Bonds on a 1 hour chart, bonds on a 15-minute chart, gold on a 1 minute chart, NASDAQ on a 1 minute chart. The ability to recognize the market maker's play gives you the ability to get the right trade at the right price. We'll finish off at that today because I think we've gone way past our bedtime on this one. So try it tomorrow. Have a think about it tomorrow. Set it up. Think about where the fat tail skews are. Because if you can figure out where the fat tail skews are, guys, you've just found asymmetry in the marketplace. Asymmetry is the key to success in every trade you take, where you've got limited downside risk and maximum slippy upside risk. Slippy upside reward, rather, right? That is what trading these fat tail narratives are all about. And fat tails come from statistics. Find the fat tail, and you've found a great opportunity to make great money. Think about it. I'll see you guys in the morning. I'm going to say adios amigos, arrivederci, auf Wiedersehen, sayonara, tutsins, taxcado, dos vidania, and spasibo. In the meantime, ciao for now. Dobrovici.